Welcome to today's Explainer, where we're diving deep into the fascinating, incredibly high-stakes balancing act of British American Tobacco. We're going to be pulling from their latest financial reports alongside global news data to unpack a story that sits perfectly at the intersection of business transformation, value investing, and massive geopolitical risk. Okay, let's jump right into this.
So you really have to ask yourself, how exactly does a 124-year-old legacy giant survive in a changing world? Because when you look at the macro pressures facing legacy tobacco right now, survival requires a massive complex pivot. You've got secular declines in smoking rates on one side and this intense growing demand for new smokeless technologies on the other. It's basically a textbook case study in whether a behemoth like this can completely reinvent itself before its core market vanishes.
Here is our roadmap for today's Explainer. We're going to cover A. Legacy in transition, checking the financial health, the North Korea scheme, mounting legal liabilities, and finally, weighing yield against risk.
All right, Section 1, a legacy in transition, from combustibles to smokeless.
It's wild to think about the sheer scale of their evolution. Founded all the way back in 1902 as a joint venture between Imperial Tobacco and the American Tobacco Company, BAT has literally been a staple of the industry for over a century. Fast forward to 2017, they consolidated a ton of power by acquiring the remaining stake in Reynolds American. But here we are in 2026, and they are aggressively pushing their A Better Tomorrow strategy, hitting a massive milestone of 35 million consumers using their smokeless products.
Now this is where the financials get really interesting. Based on their half-year 2026 report, smokeless products now make up almost 20%, 19.8% to be exact, of their total group revenue. That's up 1.6 percentage points from the previous full year. So while traditional combustibles still dominate the pie at over 80%, that expanding smokeless slice, that represents the entire future of the business.
And the momentum here is undeniable. We are talking about massive revenue jumps happening right now. Global revenue from modern oral products absolutely skyrocketed, up 65.9%. And the US vapor market, it bounced back to double-digit growth. Overall, new categories revenue is up 18%. With products like Velo Max and specific Vuse flavors rolling out nationally in the US late in 2026, we're seeing this pivot genuinely taking root. It's not just corporate speak, it's showing up on the income statement.
Moving right along to Section 2, checking the financial health, valuation, dividends, and growth.
Putting on our value investor hats for a second and looking at the sure dividend analysis, we've got a stock priced around $59 against a fair value estimate of just $45. So if you are hunting for a Benjamin Graham-style margin of safety, you are not finding it here. It's trading at roughly 132% of fair value. Because of that premium, Sure Dividend assigns it a strict hold rating. They're projecting a pretty modest 3.3% compound annual growth rate over the next 5 years, basically saying the total return outlook from this price point just isn't all that thrilling.
But here is the number that immediately catches any income investor's eye: 5.7. That is their dividend yield. BAT has maintained a payout ratio roughly between 55% and 75% over the last decade. They are funding this beefy yield through the incredibly strong non-cyclical cash flows generated by their legacy oligopoly.
Of course, there's a bit of a debate in the market right now. While Sure Dividend sees it as overvalued, Morningstar's analysis pegs the stock as fairly valued right around that $58 mark. Morningstar's argument is that the secular declines in combustible volumes are being successfully offset by pure pricing power. This keeps their profitability intact while that reduced risk portfolio scales up. So it really comes down to a classic value debate. Is that legacy pricing power strong enough to justify the current premium?
Let's turn the page to Section 3, the North Korea scheme, bypassing global sanctions.
$635 million. Yeah, let that sink in for a second. That is the record-breaking settlement fine paid to U.S. authorities in 2023 for systemic breaches of international sanctions. It's a staggering number that instantly wiped out a huge chunk of capital that could have easily been returned to shareholders or reinvested in R&D for their smokeless transition.
So how did this actually happen? From 2007 to 2017, a BAT subsidiary actively bypassed global security protocols. First, they set up shell companies in places like Singapore and China. Then, they used third-party intermediaries to process payments through U.S. correspondent banking. By hiding the true origin of the funds, they effectively tricked U.S. banks into converting local currency into dollars, which allowed them to funnel over $400 million directly into sanctioned North Korean entities.
And we need to be crystal clear here. This wasn't just some administrative glitch in a back-office compliance department. As reported by FinCrime Central, the Department of Justice directly linked this corporate misconduct to the funding of global instability. They noted that these tobacco profits were often used to support the development of North Korean weapons programs. That is a profound failure of internal controls and executive governance.
Which leads us directly into Section 4. Mounting legal liabilities, shareholders, and anti-terrorism lawsuits. Watch how this whole thing snowballed over time. Back in 2007, BAT publicly claimed to the market that they had exited North Korea due to political pressure. But behind closed doors, they covertly continued operations for another decade. When the DOJ settlement finally ripped the Band-Aid off and made this public in 2023, the stock naturally took a major hit. Now fast forward to 2026, and over 100 furious shareholders are suing BAT in the London High Court. Their argument? Management actively deceived the market for 16 years, artificially inflating the share price by hiding a massive compliance risk.
And honestly, it gets heavier. Alongside that shareholder lawsuit, military personnel, civilians, and their families in the U.S. have filed a massive civil lawsuit in federal court under U.S. anti-terrorism legislation. They are suing BAT for allegedly aiding and abetting acts of terrorism, arguing that the financial flows from these covert operations indirectly funded attacks against U.S. targets abroad.
Finally, Section 5, weighing yield against risk, the final verdict. So let's put it all on the scale and look at the holistic picture. On one side, you have a legacy business that is actually succeeding in managing its decline. They've got an attractive 5.7% dividend yield and an impressive expanding smokeless revenue base that's kissing 20%. But on the exact opposite side of that scale, you have a stock trading at or above its intrinsic fair value, burdened by the permanent reputational damage of a $635 million sanctions fine, and facing highly unpredictable active lawsuits regarding market deception and terrorism funding.
As we wrap up this explainer, here is the ultimate question you have to ask yourself when calculating the true cost of investing in this company. Is a 5.7% dividend yield and a successful smokeless transition enough to offset those historical governance failures and the lingering legal baggage? Well, that is entirely for you to decide. Thanks so much for joining me on this deep dive, and keep asking the hard questions.